what I'm going to do is I'm basically going to talk about each of these papers more or less on their own. But before I do that, I just want to say there are some common themes across these three papers. Obviously, they're all about finance in some way. But the two specific things I kind of want to focus on are what are the baseline differences between people who have access to these financial instruments and people who don't? And what is the effect of access to financial instruments on behavior? I think a lot of times we can confuse the two, but they're actually really different things, and that difference can sometimes be really, really important. So, on the first one, I only had the materials for the first half of the presentation, so that's what I'm going to focus on, the one from Ethiopia. So, two authors looking at welfare implications of access to informal credit. And basic finding is that access to informal credit improves household welfare, right? Two different methods put together. The reasoning for the two makes total sense, right? An Ivy and a Heckman selection model. So let me first start with the Heckman part, since that's what came first. So the Heckman selection is used to correct for selection. But no instrument was specified, so I'm assuming the identification is coming from the distributional assumptions. Specifically an assumption of bivariate normality, which is a really, really, really strong assumption. It's not discussed at all in the paper, so at the very least, there should probably be some discussion of it. And then what they do is they estimate the Heckman selection model, and they take the inverse Mills ratio from that, and they use it as a control in the IV. One issue with this approach is that it's an estimated regressor. So when you include it in the second regression, the standard errors are incorrect. So you have to bootstrap the entire thing from front to back, basically. Jeff Wooldridge actually talks about this exact setup in his panel textbook from 2010. And basically what he says is, since you have these two different equations you need to identify, you need two different instruments. And you need to include both instruments in both equations, and then bootstrap the entire thing. So then the IV regression. And you use one wave of data from Ethiopia. A really important point is that is LSMS data, and it has three waves of data, and it's panel data. So you can actually get 3 waves of households, which I think would help you a lot with this. So the biggest concern I had about the instrument in this cross-section is that you're looking at how many people in a community have, I shouldn't say access to informal credit, who are actually using informal credit, right? There's a slight distinction there, but the difference could be important. Communities with more borrowers could have a higher supply of informal credit. So then the question is, why is the supply higher? I can think of 2 reasons. And they both go in opposite directions, which makes it a little difficult to actually sign which way we think this is going. The first one could be there's a bunch of informal credit because there's a lack of formal credit, right? Formal credit generally is at lower interest rates than informal credit is. So it matters. And in that case, if there's no formal credit, maybe it's a poorer area. But you could also make the argument that if there's no formal credit anywhere, the places with more informal credit could actually be richer. Right? So at the very least, I think there at least needs to be a bit more digging into exactly what these different communities look like. But where I think you could really get some traction here is bringing in the other 2 waves of data and doing something, for example, with fixed effects like you did in Pakistan. But here you can do it with household microdata instead of aggregate data. And then the last point on this one I want to make is that I think the mechanisms are really important. Borrowing alone shouldn't increase your consumption. If you borrow some amount of money, you have to pay it back. And then you have to pay a little bit more because of the interest. You have to do something productive with the credit in order to increase your household consumption. Now, when I say something productive, I don't necessarily mean you have to actually go out and buy something. It could be preventing you from disinvesting, right? So you talk about using livestock as a buffer. If you have to sell livestock in a lot of developing country contexts, especially in sub-Saharan Africa, but also in South Asia, livestock is really productive. It actually gives you a lot of money. It's an income stream. So having to sell it is a hit on your future income. So if, for example, you can get credit and it prevents you from selling it, that could increase your productivity, at least relative to what it would have been if you didn't have access to the credit. So I think this is actually a really important point about exactly why you think you see what you see, right? I think sometimes I'm okay with the black box, but I think here the exact reason is really important. And then just a couple suggestions. I think if you're going to go with the Heckman selection, you have to find a second IV. A possible alternative is instead of first estimating whether you have credit and then estimating how much credit you have, is why don't you just estimate whether you have credit? So it's a slightly different interpretation. It's not going to be how much you have. It's instead going to be, do you have it, yes or no? But you only need one instrument. Or if you bring in other waves, you could conceivably do it with fixed effects, just depending on what it looks like. So I think that might be really helpful, the extra waves. And then the second, I think the mechanisms are really important and at the very least should be discussed, even if you don't think you can necessarily pin them down. Okay, moving on to the second paper. I've actually seen this paper presented a couple times, and I really like it because the context is really unique. A lot of us that do development work are used to working in rural areas that have poor transportation, but these areas, it's a whole new level of lack of transportation. They're not even connected. The places that are on the mainland still aren't connected by road to the rest of the country. It's all forests and mountains. And then a bunch of them aren't even on the mainland, so to even get there, you have to take a boat. So it's really, really remote. And the authors don't find any impacts of this financial, this expansion of access to basically a bank account, right? And the big question asked is why? And the authors kind of talk about two big possibilities that I think both make sense. The first is limited access to banks, right? So even if you give someone a savings account or a checking account, if it takes them 7 hours to get to it, it makes sense that they might not use it that much. The marginal costs are just too high relative to the marginal benefits, so they just don't use it. They opened one because someone came to them, but they're not going to use it again. And the second is that people don't need banks. I think there is an assumption in almost all financial inclusion literature that people need banks. And I think at some point that is true, but I don't think we should ignore the fact that a lot of people might not need a bank right now because there are more pressing problems. Like, for example, the lack of something to do with that credit to become more productive. But the one thing I actually want to focus on is this one slide. So the way I read one of these theories of change is that each step in the process is kind of a necessary condition to go on to the next one, right? So for example, if people don't participate in the program, none of the rest can happen. If they don't improve financial planning behavior, none of the rest can happen. And the authors show all 4 of these, actually. They show all 5 of them, right? But their explanations kind of fall into these last 3 buckets. But the thing about that is there's absolutely no impact on financial literacy. So if you think this is the correct theory of change, my question would be, why aren't any of the explanations focusing on where we first see no effects? I feel like there needs to be more explanation of, hey, there was nothing here, and in our theory of change, that suggests nothing else should happen. If you don't think that's right, then I think maybe the theory of change might be a little different. I could imagine a theory of change where improved financial literacy actually doesn't make as big of a difference as just having access to the bank account. But the way it's written right now, it seems like the focus should actually be on that first block where we don't see any effects, which is financial literacy, right? Here it is. They're not just insignificant, they're tiny, right? The coefficients are incredibly small. You could increase your sample size by like 4-fold and nothing would be significant, right? These are tiny effects, or tiny null effects, I should say. So I think there needs to be more focus there. Okay, those are the only comments for that. And then the last one for Kim Buyol. This is completely outside of my area of expertise. I know absolutely nothing about Korean financial instruments at all, let alone mutual funds in 2007 and 2008. So take all of my comments with a grain of salt. So these 4 different groups, overconfident, underconfident, and then the people who correctly judge their ability, if you want to think about it that way. The construction of the groups makes perfect sense. It's really straightforward. One thing I kept asking myself everywhere is, what does the composition of each of these groups look like? Education, income. You had the general summary statistics table. I almost feel like you need 4 columns in that statistics, the summary statistics, one for each of those 4 groups, so I can kind of better understand what these people look like. One thing specifically I wonder about is whether some of these differences are actually a proxy for risk aversion specifically. When I think about the kind of bad example I got is if you ask someone if they want to go skydiving, right? And the objective risk is not that high, right? So the difference between the people who say, I'm not doing that, is because their subjective evaluation of the risk is higher than the objective risk, right? But all that is driven by risk aversion of some kind, well, arguably driven by risk aversion. And finance, when you're talking about losing a bunch of money, I think it's actually a similar thing. Individual level variables, but household level investment. How should I think about that? What exactly is going on if you're talking about household mutual fund investments, but individual level variables, specifically on the subjective stuff? So when you ask someone, do you know this fee? Well, I'm assuming the fee is different across different mutual funds, depending on who's managing it. At least it is in the States, right? So I assume it is here too. Which one are you talking about? You know, someone may have a great idea of the household's overall investments, but they don't necessarily know all the fees because their spouse actually controls one of them, for example. The second part is just, I was kind of surprised that a 30-year sample reported earning profits from a mutual fund. That sounds low. I don't know if it is because I don't know anything about investment in Korea, but my initial thought was that seems really low. How are profits defined, I think, could be part of that. Does it just mean beating the market? Does it just mean beating inflation? Does it mean I actually had dividends? Does it mean I sold it and actually made a profit this year? I think all of those different explanations could explain why it seems lower than I expected it to be. But of course, I could just be wrong and it could just be that low. But then why are any of you investing in mutual funds? In table 3, you use individual fixed effects for the crisis sample, but you use a different identification strategy for the rest of it. So if you think, my main concern here is that it's completely different variation. It's within individual versus across. So I'm not sure that the comparison is really apples to apples. If you think the kind of cohort fixed effect thing you do is sufficient, then you should just do that for the 2007-2008 wave and compare like actual, this is the exact same specification. If you don't think that's sufficient, then why should I trust those follow-up ones anyway, right? So at least the same specification, so there's really an apples-to-apples comparison. A specific concern I have is we know there's probably going to be a bunch of measurement error in those knowledge variables, and we know that at least classical measurement error, which I know technically can't exist here because of the way those variables are created, could attenuate your estimates, and fixed effects make that much worse. So that could be one possible explanation. Okay.